Hello there, my name is Lou Wieland, and I publish the official relocation guides on Atlanta that are distributed by the First Multiple Listing Service of Atlanta. The magazines are on the First Multiple Listing Service of Atlanta website, fmls.com, and those are accessible only to realtors who have access to that website. There are about 52 or 53,000 agents in the metro area and throughout the state of Georgia who are members of FMLS and who consult that website regularly. The magazines are also on my website, atlantacommunityprofiles.com, along with a great deal of other information on Atlanta, including some of my previous shows. We did a show last week with the president of the North Fulton Chamber of Commerce, and the previous week with the ATL Aerotropolis Atlanta president and chief executive officer. And I'm also a realtor with KW Commercial. I focus mostly on multifamily, and my website is louwieland.com. I'm multifamily and really all kinds of commercial real estate. Currently looking, by the way, for a liquor store, a hotel for investors, and a car wash, and other investments. If you have any of those that you know about, please let me know, and I'll be happy to be of assistance to any of your friends or clients who need assistance in that area. Every week we interview community leaders, and basically those shows are on my website, Atlanta Community Profiles, and on my YouTube channel, which are connected to the website. If you would like to, if you missed this interview, you can see that on the website right there on that YouTube channel. And so I saw an interview that one of our senior realtors did with David Kahn at CoStar a couple of weeks ago, and I invited him to come on the show to give us give everybody an opportunity to see that. I think the interview was only available to KW Atlanta. KW Commercial Atlanta Realtors. So, David, great to have you on the show, and thank you for taking time from your schedule to share that information with our viewers.
Absolutely. Happy to be here, Lou, and welcome back from a busy Labor Day weekend.
Yeah, we're out trying to find properties for clients pretty much all weekend, but David is the Director of Market Analytics for CoStar. Just by way of explanation, CoStar provides information, analytics, and marketing services to multifamily and commercial real estate, with leading brands not only CoStar but also LoopNet, Apartments.com, Lands of America, and BizBuySell. CoStar is the world leader in commercial real estate information, the most comprehensive database of real estate data throughout the United States, Canada, and the United Kingdom, and United States, Canada, United Kingdom, and France. So you are going to see an updated information presentation on Atlanta that's normally only reserved for people who subscribe to CoStar. So I hope you enjoy the presentation. I'm going to just turn it over to David and let him help you understand what is actually happening in the Atlanta market for commercial real estate.
Absolutely, and thanks again, Lou, and happy to be here and for everyone tuning in. Nice to see you, and really my goal here today, as Lou mentioned, is to give a broad kind of a 30,000-foot view overview of the Atlanta commercial real estate market, what's going on from an office, industrial, multifamily, and retail perspective, and starting out what's going on with the economy, because economic growth clearly has a major impact on all 4 commercial real estate sectors. And without further ado, I will dive in. So overall, looking at the pandemic recovery nationally, before we get into Atlanta, I want to just put in perspective how strong the economic recovery has been so far. Of course, there's concerns about Delta. The most recent job numbers were weak, so we'll see how that plays out. We still have unemployment above the pre-pandemic average, but all in all, we've done a great job to recover from the economic crisis. And it really was a crisis. We saw here GDP fell significantly, but as of the most recent numbers, we've actually seen GDP exceed the pre-pandemic trend. And our economic shop, Oxford Economics, that provides our economic forecast, is projecting us to stay above that pre-pandemic trend for quite some time, really the next few years or so. So economic growth, we have seen a rebound. We're still not out of the woods just yet, but all the forecasts call for stronger than pre-pandemic growth over the next few quarters and next few years. And that should lead to stronger demand for commercial real estate space in all 4 major sectors. Now, honing in on Atlanta a little bit, the July numbers were down a little bit from the June numbers, not too much of a concern. If you look at where we're adding those jobs back, total non-farm, almost 20,000 new jobs. Leisure and hospitality saw a big boost. But really, I want to focus in on that professional and business services and information. When you look at Atlanta and you look at a lot of the jobs that we're adding right now, especially in town areas, Microsoft, Norfolk Southern, Google, all of these tech jobs, that's going into the professional and business services and information services sectors, and those were outperformers last month. So it's really those high-end, high-paying tech jobs that are helping drive the market right now, and that's leading to higher consumer spending and more demand for single-family and multifamily housing, high-end multifamily housing. Now, looking at Atlanta versus the February 2020 peak, as I mentioned, we're not out of the woods just yet. We still have about 2.5% more employment to go before we reach that pre-pandemic employment level. The good news is the pace of our job growth has picked up over the past couple months, and we've consistently outpaced the national benchmark really since the start of the pandemic. So you see Atlanta in the blue, national average in the red. We've been outperforming the national average, and we continue to, and we should reach our pre-pandemic employment hopefully by early next year or mid next year. Now, when breaking that down by sector, you really see a big dichotomy in terms of the jobs that we still have left to turn back, to gain back. All the way on the right side, leisure and hospitality, we all know that sector got hit especially hard. It was difficult to travel. People weren't eating out as much, and we're still understaffed compared to pre-pandemic norms in the leisure and hospitality sector on a percentage basis. Now, all the way on the left-hand side, it's professional and business services, financial activities, construction, and trade transportation. So if you think there, it's those high-paying office jobs, as I mentioned, professional and business services and finance, as well as the logistics jobs. And as we'll see in the industrial portion of the presentation, our logistics sector, our industrial sector has been performing quite well over the past few quarters or so, and that's driving a lot of growth in the metro's economy as a whole. But again, the star of the show has been these high-paid office-using jobs, a lot of tech firms moving to Atlanta. So just looking at this list, this is over the past 2 years or so. You've got Google, Microsoft, NCR coming to Midtown, Norfolk Southern, Salesforce, State Farm with their big campus, Deluxe Corporation, which is a big move, big win for Central Perimeter, and then MailChimp and FanDuel, that's to come. And it's just added a lot of these higher paying office using jobs and contributed to a really robust demand side picture from a multifamily perspective, single family perspective, and then before the pandemic from an office perspective. And looking at our office using job growth since 2010, we're well above that national average. Sure, we're not on the same scale as Austin and Nashville, but on a percentage basis, when we've added about 33% of our current office jobs just over the past 10 years, and we continue to add these major corporate relocations and expansions, that really helps the demand side picture for all sectors of commercial real estate. One of the reasons why we keep attracting these corporate relocations and expansions and these office using jobs is we're one of the most highly educated metros in the country. And we remain a bargain compared to most coastal metros. If you think San Francisco, you think New York, very expensive to live. Sure, you have highly educated population, but it's very expensive to recruit people there and to hire. Here you have a high percentage of college graduates, but in terms of our multifamily rents, our single family home prices, they've been rising at quite a fast pace, but they're still right around that national average and well below Northeast and West Coast type metro areas. So looking at that from a percentage basis and a nominal basis, look at that percent, that diamond right there in the orange. We've got about 40% of our adult population has a bachelor's degree or higher. That compares favorably with other metros such as Philly, a little bit below San Francisco, but comparable, Chicago, Dallas-Fort Worth, New York, very similar in terms of a percentage basis. But in terms of our multifamily rents and our single family home prices, we're right around that national average. So again, rents have been increasing at a breakneck pace. We'll see that in the multifamily portion of the presentation. But all in all, we remain a bargain compared to those markets all the way on the left side: San Francisco, New York, San Jose, Boston, Orange County, San Diego, where we come at a significant discount, and you don't have to sacrifice quality of labor to locate or expand in Atlanta. And this has helped contribute to strong population growth. And again, 1% last year is a little bit down from our recent 10-year average or so, but we're still about double the national average in terms of our population growth. And at the end of the day, more population means more demand for commercial real estate, and we keep doing a great job of attracting more people and corporations to Atlanta. So lots of jobs, lots of labor to fill those jobs, and has helped grow our economy by leaps and bounds over the past decade. So that's a brief economic overview of what's going on to set the stage for the commercial real estate portion of the presentation. First, we'll start out with office, which should come as not much of a surprise that office has gone through some pretty significant changes over the past few quarters, really since the start of the pandemic, with the rise in remote work and the fact that we're still not totally back to the office like many people expected us to with Delta and some of the other variants out there right now. We hope to see that starts to reverse in the coming months, but still a lot of uncertainty with the office market. And that uncertainty is still weighing on corporations, tenants' ability or their really appetite to sign for large blocks of space. And the first thing that we like to look at is just overall leasing volume. Leasing, you sign a new lease that typically leads to some positive net absorption or net move in, net move out. When you see that type of churn, that means that there's a healthy market. So we're typically used to 3 to 4 million square feet per quarter of leasing activity. Well, since the start of the pandemic, we've been more around 2.5. So until we start to see leasing activity get up to that 3 to 4 million square foot per quarter, we don't expect to see a robust recovery from the effects of the pandemic. So still to be seen, but overall, the overall office market is still performing below that pre-pandemic trend. And another cause for that is the large glut of sublet availability on the market right now. So not only are tenants not signing as many leases or taking as much space as they were prior to the pandemic, but many tenants have opted to give back some space or really forego their office entirely. So you have, some firms are looking to completely shed space and go purely remote. Some are looking for a hybrid. Synchrony Financial would be one up in North Fulton. They went pure remote. Other firms are just looking to kind of put some space on the market, fish out to see if they can do some kind of a hybrid situation. Other firms like Flexport, they put on some sublet space and decided to actually take that back from the market and sign an expansion. But all in all, you do see some positive, some negative. All in all, we've still seen a large increase in sublet availability. And until that starts to dissipate, until firms start to take some of the sublet space and occupy it, we don't expect to see a real robust recovery in the office market from a supply and demand and vacancy perspective. So another thing that we look at is the difference between availability and vacancy, because usually what happens is tenants will put space on the market as available space, and whether they're moving out to a new space or that available space comes on the market in terms of speculative supply, what happens is when that availability rises, the vacancy rate is likely to rise thereafter. So we take that as a leading indicator, and really specifically the difference between the availability rate and the vacancy rate as a leading indicator for vacancies. So you see that difference really rose at the end of last year, and then vacancies started to rise after that availability rate started to dissipate. What we do expect, even though we see an increase in sublet availability, that pace of the difference, the pace of the increase between the availability and vacancy rate has moderated a little bit. So we don't expect to see a major run up in vacancies over the next few quarters, more of a flat or slight increase. So a little bit of a good sign, but again, we need to see a big surge in leasing activity and sublet space coming off the market for us to see vacancies fall back down to their pre-pandemic level. And that still remains to be seen. We haven't seen a big increase in leasing just yet. Now, another thing that we're tracking closely is the construction pipeline. And the good news is the construction pipeline has moderated over the past several quarters. We have about 5.5 million square feet underway right now. That's down from more than 8 million square feet right before the pandemic hit. And at this point, about 50-50, about half of it is speculative and half of it is leased. Won't have a huge impact on the Metro's fundamentals, but it's still a little bit of a concern. We still have a lot of space underway that hasn't been leased yet, that if it doesn't land a tenant, it will cause that vacancy rate to increase. Now, what does this all mean for supply, demand, and vacancy? To break down this chart, you have quarterly change in supply in the blue, quarterly change in demand in the orange. That corresponds with the right-hand axis, and then the vacancy rate, which corresponds with the left-hand axis. And what you could see is those major move-outs that happened late last year and early this year caused that vacancy rate to rise. As I mentioned before, big amount of sublet availability and some major tenant move-outs have weighed on the market. The forecast does call for a little bit more negative net absorption over the next few quarters. We will benefit from, Microsoft just moved in, Norfolk Southern's about to move into their new space, and a couple other big tenant moves like Google. But all in all, until we start to see the leasing activity start to ramp up to that 3 to 4 million square foot per quarter benchmark, we don't expect to see the vacancy rate to start to fall, to start to inflect, which this forecast calls for in late 2022 and early 2023. So again, still a lot of uncertainty with the office market. You could see once we get back to normal and once Delta goes away, hopefully, knock on wood, firms start to really take more space. But until we see that critical mass of leasing volume and leasing activity, we still expect to have profound weakness in the office market over the next several quarters or so. And the weakness in the fundamentals has led to weakness in rent growth. Owners have generally opted to freeze rents. So we're not seeing the 5, 6, 7% annual increases that we were seeing right before the pandemic hit during the strong, tight office market. You're seeing places like Midtown and Buckhead with 8, 9% rent growth. Now it's basically flat across the board. And another reason for that is the amount of sublet availability. Not only is it causing the availability rate and the vacancy rate to increase, but it's weighing on asking rents. If you look at the sublet availability and the direct rent, and you look at those two rents and match them up with one another, there's a big discount between the available direct rent and the available sublet rent. And what that just does is it gives tenants who are looking for space more bargaining power. They can say, why would I lease this space if I can go to this sublet availability, especially if it has long-term and has might come with a couple of perks, they might opt to look at that as a discount, or at least use it as a bargaining chip and say, maybe I won't renew, maybe I'll just go to the sublet space for a little bit of a discount. So until this starts to narrow a little bit, it's going to be more and more difficult for owners to push rents in the direct space and that new space compared to pre-pandemic. And as I mentioned before, the rent growth slowdown has been pretty much everywhere. Even your hottest submarkets going into the pandemic at the bottom right, like Cumberland, like Midtown, like downtown was really ramping up, Buckhead. We haven't seen much rent growth at all in really any submarket in Atlanta. But one thing that we are starting to see is an uptick in sales activity. Now, a lot of this is due to a couple big triple net leased office deals. So 1224 sold up in Central Perimeter. That fetched a record pricing for a suburban property. And then the Anthem deal in Midtown, that fetched a record price. So owners are still looking for those well-located, well-leased spaces, and they're willing to pay a premium for them, 725 Ponce as well. But other than that, generally pricing has remained relatively flat. 2021, again, we've seen that uptick, some of those big deals really driving deal volume recently in the office market. And pricing has generally remained flat over the past few quarters or so. So, the moral of the story here is a lot of uncertainty with the office market. Some owners are really honing in on those well-leased, well-located properties. Value add is still somewhat of a play here if you can get a deal at a discount. But the good news is owners are not selling for a significant discount. We're not seeing distressed sales. Owners are well capitalized. Banks don't want to take over the keys of a property. So we'll see how long that lasts. If we continue to see weakness in the market, we could see some more distressed sales or property selling at a discount. But so far, so good from the office market. So that's office. We're going to head into industrial, and it's going to be a little bit of a rosier picture here. So the industrial market, as I mentioned, is really on fire right now. And a reason for that, or a main reason for that, is retail sales and food services growth has been tremendous. So you can see during the pandemic, retail sales and food services essentially fell off a cliff temporarily due to the initial lockdowns, while e-commerce made up for almost all of that loss. Well, over the past few months, the federal stimulus, the economic recovery has really helped boost spending power for individuals, and retail sales and food services has skyrocketed, but that hasn't come at the expense of e-commerce just yet. So e-commerce, that's driving industrial, but also retail sales and food services overall. You need to get goods, you need to get food to people's tables and to grocery stores. So really all of this the increase in consumer spending overall is a boon for the industrial market. And it's really a boon for Atlanta because we're a major inland port, regional, super regional distribution hub. We're an inland port. We also benefit from the Port of Savannah, and the Port of Savannah has continued to post record port traffic over the past few months or so. We're well above our pre-pandemic trend. There's issues with West Coast ports, but really since the Panamax, the Panama Canal, and then some of the infrastructure improvements that we're seeing in Savannah, that's only going to help improve all of the freight that's going through Savannah. And so much of this goes right into Atlanta, gets unloaded, gets put out, whether it's by rail, whether it's by road and truck, it's going to come through Atlanta most of the time, and that's driving a lot of demand for Atlanta industrial space. So remember the office leasing activity chart where we saw a slowdown compared to pre-pandemic. Quite a different story in industrial. Our two best quarters from a leasing perspective on record were Q1 and Q2 of this year, and Q3 is also looking quite strong. So, you're leasing 14 million square feet a quarter. That's exceptional, and that's leading to some of the best net absorption in the entire country in Atlanta over the past several quarters. So we're just under 30 million square feet over the past 12 months, just behind Dallas, Fort Worth, but ahead of Chicago and the Inland Empire. Again, all of that strong leasing activity leading to exceptional net absorption, exceptional demand for industrial space throughout the Atlanta region. But developers have taken note, and they're looking to take advantage of this strong leasing activity environment, and they've broken ground on a bevy of projects, a lot of projects over the past several quarters or so. So 9 million square feet breaking ground in Q1, about 7 million square feet breaking ground in Q2, and most of that is breaking ground on a speculative basis. So when you think about it, it's not going to be a build-to-suit. Typically, developers are feeling confident enough in the market that they're going to fill this space quickly, either before that property receives its CO or shortly after. And it's really incentivized developers to say, hey, we're going to break ground on this thing, and we're not going to worry about a tenant just yet. We'll market that space, and we'll see. Hopefully we'll sign someone pretty quickly. And so far, so good. New spec deliveries have leased up quite quickly throughout the Atlanta region in recent quarters. That said, we're still at a record high in terms of construction activity, more than 25 million square feet underway. About 60% of that is unleased, 40% pre-leased, which actually compares favorable to other major distribution hubs such as Dallas and the Inland Empire. I wouldn't say that this is getting over our skis or anything at this point. The amount of leasing velocity that we're seeing really does point to a market that needs more speculative supply. And as we'll see, the vacancy rate in Atlanta continues to fall, so we might see even more speculative groundbreakings in the next few months. Now, where is most of that supply? It's going to be in your South Metro submarkets such as Airport North Clayton, Rockdale Newton, South Clayton, Henry County. Kennesaw Ackworth is an exception there in the Northwest quadrant, and that's 75, as well as the Inland Port, which is a straight shot to the Port of Savannah up in North Georgia. It's the closest submarket to there. And then you have some Northeast submarkets such as Duluth, Suwanee, Beaufort, and North Fulton, Forsyth, which there's been more last mile type distribution facilities that are going up there. Still pales in comparison to the South Side, but pretty strong in terms of construction activity throughout the metro. Now, I mentioned before, all the developers, they're breaking ground on speculative construction. Well, why? Because the vacancy rate in Atlanta continues to fall. Historically, we look at vacancies in Atlanta of about 9 to 10%. That's our historical average going back to 1990. And we're right around 4% right now. And that's down from about 6% right before the pandemic hit. So despite all of this new supply coming to market, leasing activity has been strong enough to push that vacancy rate down. Again, it's one of the hottest markets in the entire country from an net absorption and leasing perspective. And even with that record high construction pipeline, the forecast calls for relatively flat vacancies over the next few years. All of this consumer spending, the economic recovery, and the fact that Atlanta is such a major regional and super regional distribution hub should continue to attract major tenants to the region and fill a lot of these brand new big box distribution facilities. Now, strong leasing activity and a declining vacancy rate has given owners the ability to push rents at an impressive pace. And again, unlike that office rent growth, we've seen rent growth accelerate over the past few quarters or so. We were heading into the pandemic, one of the strongest rent growth markets in the country, a little above 6% annual growth for the past half decade or so. That's accelerated to 8-9% over the past couple quarters. So if that vacancy rate remains at 4 or 5% or so, we could see above average gains for quite some time. If we do see spec supply start to kick in and leasing activity start to slow, we might see a slowdown in rent growth in the latter years of the forecast. But I would bet that we will probably see stronger than average growth for at least a few more years, considering how low our vacancy rate is right now. And again, we rank as one of the top markets in the country for absorption as well as rent growth. We're number 10 for annual rent gains right now. Quarterly industrial sales transaction, we took a hit a little bit in Q2 of 2020, but transaction activity has ramped up over the past few quarters or so, and average pricing has actually accelerated. So again, strong rent growth, tighter than ever vacancies. It's attracting more out-of-state institutional and even international capital to Atlanta industrial facilities. Now, Lou, I know this is near and dear to your heart, but the multifamily market is doing some exceptional things right now. Number one, what we like to look at as a leading indicator for demand is apartments.com search activity. So more people are searching on their computers, on their tablets, on their phone, more likely it is they're going to tour and sign a lease, and that will lead to demand and give owners the ability to push rents. Well, since the start of the pandemic, we've seen search activity rise, and then this year we've seen it really surge. So what that's done is just led to more leases signed and a tighter market, giving owners the ability to push rents at unheard of pace. So again, all of that search activity is leading to people actually signing leases. And this is the availability rate broken down by overall market in the green, suburban, and then in the red, and then urban in the blue. And you could see the pandemic, urban did take a hit. All those ITP, in-town properties, Midtown, Buckhead, downtown, East Side, they did take a hit, and the availability rate rose up to 9%. But as of early August, that was down to right around 4%. So think of the difference between these properties. They're used to being 97, 95, 93% full, 91% full, and now they're 96, 97, 98% full. It's giving them the ability to push rents at really an unheard of pace. Suburban, we're down below 3% for availability. Again, a record low, and giving owners the ability to push rents at quite a strong pace. So that's availability rate, and what's driving that? Well, it's lease-ups in new properties. So monthly lease-up in urban ITP properties. You saw in the middle of the screen there, lease-up was quite slow in 2020, especially in April, May, and June of last year. It did improve in the second half of the year, slowed a little bit through December and November, and then it slowly recovered until June, a record month for lease-up for those urban properties. So people, now that they're vaccinated, now that things have opened up, and again, knock on wood, Delta won't impact that too much over the next few months, people have leased apartments at a breakneck pace, and has really led to that declining availability rate and declining vacancy rate. And suburban has outperformed urban recently, did come back to around 20 units per month through the second half of last year, and it stayed there in early 2021. And then the last couple of quarters, suburban lease-ups have averaged better than 25 units per month, which is exceptional. Most developers, they underwrite 15, maybe 20 units a month lease-up. 25, anything above 25 is quite exceptional. Now, we're not building that much in terms of our multifamily supply right now. That may come as a surprise to some people. We're typically and what you can call an overbuilt market. We build a lot of housing in general historically, but recently we really haven't built that much housing. We've built just as much housing, right amount as much housing as Charlotte over the past 10 years or so, which is about half our size. Austin, Nashville, they've built comparable amounts of new supply as us. And again, we're a much bigger market. If you look at construction activity fell off a cliff following the onset of the pandemic. No one was breaking ground on deals in Q2 and Q3 of last year. But now that the market's recovered, developers are trying to play catch up because they're looking at these record low vacancies and this record strong rent growth. They're trying to get in on the action. And we've seen construction starts increase recently. We're up to around 16,000 units underway, about 3% of inventory, still not nearly enough to keep our rents from skyrocketing. But, hopefully we'll start to see this increase a little bit because clearly the demand is there for housing throughout the Atlanta region. I mentioned this before, construction starts basically fell off a cliff in Q3 of last year. But they've trended upwards. We've seen strong quarters for construction starts in Q4, Q1, and then in Q3 so far. But again, we're not really up to the amount of construction that we saw heading into the pandemic, which is really what we need to keep us more affordable than we've been recently. So a lack of supply and record lease-up, record absorption has driven that vacancy rate way down. So again, looking at early 2020, our vacancy rate was about 9% overall, and now we're below 6%. So when the market's used to being an 8-9% vacant market, now it's around 5-6%, gives owners the ability to push rents at an impressive pace. And because there's not a lot in the near-term pipeline, a lot of the projects that just broke ground, they won't deliver until late next year, early 2023, will likely remain a pretty tight market, at least through next year, through 2022. After that, we could see supply start to kick in a little bit more, but as of right now, we're looking at another strong year from an absorption and from a vacancy perspective in 2022. So what this is doing, it's allowing owners to push rents at unheard of paces right now. Here you see our daily rent series, which is powered by apartments.com. Rents were up, just a little bit last year. They fell and then they recovered, and they were around 2% above the pre-pandemic peak by December. Well, now as of early August, rents were 20% above the pre-pandemic peak. So 20% above where they were in early 2020. The national average about 8, 9, 10% above. So we're well outpacing the national average. And then looking urban, suburban properties have continued to outperform, but urban, which those ITP properties, again, they were dealing with a little bit of an exodus last year with people moving out to the suburbs. That seems to be temporary. And right now, urban rent growth is quite strong. It's actually just as strong as the national average. So when our lesser performing assets are performing just as well as the national average, you're in pretty good shape. And then the suburban properties are doing quite well compared to urban. Now, on a year-over-year basis, where are we seeing the strongest rent growth? First thing that I'll point out is every single submarket, except for South Atlanta, is 10% or better for year-over-year gains. And that's a record for every single submarket on here. So we are playing with house money right now. And anyone who's a multifamily landlord now, they're just figuring out how fast they're going to be able to push rents and how sustainable this is. The leaders right now, North Fulton, Kennesaw, not a ton of supply, strong demand, good schools, good access to jobs, and they've really benefited from that pandemic trend of people looking for more space in the suburbs. Cherokee, Fayette County, and the south side's also been strong. So is Sandy Springs and Forsyth. On the north side, Henry County's been a leader over the past few years. And then Gwinnett County submarkets, those two I want to point out because those two submarkets have seen a ton of new supply. And despite that, they're seeing better than 20% annual rent growth. Even our bottom performing submarkets like Buckhead, Midtown, East Side, you couldn't really call them bottom performing. They're above 10% and they're trending in the right direction. They were hit hard by the pandemic, but they've more than recovered from those rent losses, which were pretty mild compared to other downtown areas throughout the country. So what does this look like from a year-over-year basis and nominal rents? The red line here is our asking rents over time and the year-over-year rent change in the orange bars. And if you look, where are our rents right now compared to where they were in 2010? We're well above where they were, about $900 a month back in 2010. Now we're $1,500 and trending higher. On a year-over-year basis, we're closing in on 20% metro-wide, which is one of the strongest markets in the entire country. Now, the big question is how sustainable is this? And because our vacancy rate is so low right now and we don't have a lot in the near-term pipeline, we do expect to see some above average gains at least through 2022. So 2022, we're expecting around 6-7% rent growth coming after 15% this year, so better than 15% this year. But then after that, we do expect that round of supply that started to break ground right now to kick in and lead to more modest rent gains. The downside, of course, is people just won't stomach these types of rent increases any longer, and the federal stimulus has started to fizzle a little bit. We'll see if there's another round of stimulus, so that could be an impact here. But overall, we do expect stronger than average, but still more moderate gains over the next year or so. And then lastly, from a transaction perspective, it's very competitive market out there in the apartment scene. We're seeing out-of-state investors. We're seeing multiple bids on every single deal that goes to market, and we're seeing prices properties sell for above asking prices. And again, people are buying into not just Atlanta as a whole, but this rent growth and the strong demand that we've seen recently. Everyone wants to get in on the action here, and they're willing to pay top dollar. We've been one of the strongest markets from a trailing 12-month perspective in terms of sales volume, right along with Phoenix and Dallas-Fort Worth. A lot of capital keeps making its way to the Sun Belt, and a lot of capital keeps making its way to Atlanta. And as I mentioned, these bidding wars are pushing prices higher. We've seen year-over-year price growth closing in on 20%, while pre-pandemic the trend was around 10%. 10% was pretty good for the past half decade or so, but 20% is very strong, and average pricing has continued to accelerate. So a lot of these deals out in the suburbs and in in-town submarkets, they're going for well above pre-pandemic pricing. And it seems like there's no end in sight with cap rates continuing to compress and with capital from out of state and even out of the country just bidding up on deals that traditionally were not going for super high pricing. And then lastly, I'll wrap up with the retail market, and might come as a surprise to many people, but retail has fared quite well since the start of the pandemic. Of course, there was that initial shock of shelter-in-place, stay-at-home orders. But since then, we've seen a pretty strong uptick in leasing activity and pretty strong rent growth in Atlanta, at least. So again, Atlanta retail leasing volume has trended in the right direction over the past few quarters. You see that big fall off in the second quarter of 2020 really stands out here, but then we quickly got back to that pre-pandemic trend. And then 21 Q2 last quarter was the strongest quarter in a couple of years from a leasing perspective. So we're essentially back to pre-pandemic from a leasing perspective for retail, at least. And that bodes well for positive net absorption in Atlanta retail. Now, what else has helped the market? It's the lack of construction and the lack of speculative construction. So if you look, we've got about 2 million square feet underway right now. Look back to 2007, 2008 during the great financial crisis. We were building 7-8 million square feet, and a lot of that was speculative. So that would deliver without anchor tenants and just cause that vacancy rate to skyrocket. Well, now of that 2 million square feet or so, most of it is pre-leased. So it doesn't have too much of an impact on overall market fundamentals. 2 million square feet in a market this size is not much of an issue, not much of a concern from a fundamentals perspective. And especially considering where we're building our retail in fast-growing exurbs and fast-growing suburbs. We're not building big malls in the middle of nowhere with no pre-leasing. We're building generally smaller strip centers in strong demographic areas or areas which have been under-retailed for quite some time. So Walton County would be one of those. Swanee-Buford with the Exchange at Gwinnett project that's almost entirely leased right now, and that's a big mixed-use project up there. Coming for Forsyth County, one of the fastest growing counties in the entire country. So of course they need to build some more retail, but they're not even building that on spec. So we're seeing smarter growth and less of a large scale growth, more smaller centers and mixed use type properties, which has really helped the retail market recover over the past few years. So looking at supply, demand, and vacancy, we did see a run up in vacancy early in the pandemic. A lot of stores were forced to close, and we did see some big box retailers shut their doors permanently. You see the negative absorption in the second and third quarters of last year. But since then, we've seen 3 quarters of positive net absorption, and the vacancy rate has fallen. And because there's so little underway and the fact that we've seen leasing activity start to pick up, forecast calls for relatively flat vacancies and a tight retail market. You compare that to the great financial crisis, look at all that supply we were delivering, and not a lot of it was leased. So when you couple that with some negative absorption or even flat net absorption, vacancy rate skyrocketed to over 10%. Look at that compared to where we are now, 5% or so. Totally different market right now. And the fact that we have been so resilient from a fundamentals perspective, it's given retail owners the ability to push rents, which many people did not expect to see that type of recovery so quickly. But it makes sense when leasing activity is picking up and there's just not as much vacant space out there. We've seen rent growth right now better than 5-6% right now metro wide, and that is well above the pre-pandemic norm. So we were right around 3-4% for a few years. Now we're around 6, closing in on 7%. So we're faring quite well compared to pre-pandemic. And another thing to point out, it was a really slow and long recovery from the effects of the great financial crisis. We were finally above our pre-Great Recession level by late 2019, and going into the pandemic, we thought, here we go again. We're going to see rents fall, but the fact that we've been this resilient, our demographic growth, the effects of the fiscal stimulus, and the low vacancy rate has really helped the market recover, and owners are pushing rents at quite a strong pace once again. How strong of a pace? Well, we're one of the strongest rent growth markets in the entire country right now. So Nashville, one of the fastest growing markets in the country. Tampa, very fast growing. Seattle, Inland Empire, Indianapolis is up there. But we're number 3 in terms of major markets for year-over-year rent gains, closing in on 6% right now. Again, things are looking good for Atlanta retail. And until we see a big increase in speculative supply, things should remain relatively strong unless there's this huge surge in Delta or some other variant and we have to go back to lockdowns, which doesn't appear to be too much of a concern. It could happen, but we hope not. And then from a transactions view, transaction volume has set a record each of the past 2 quarters, going back to 2007, or at least a decade record for quarterly sales volume. A lot of this is driven by net lease properties, but suburban centers have been really at the top of mind for a lot of investors and a lot of out-of-state investors. Publix anchored centers, they seem to be closing on a weekly basis throughout suburban Atlanta, both on the north side and the south side. So well-leased suburban centers with strong demographics, strong traffic counts are driving a lot of sales volume throughout the Atlanta metro recently. And because of that, and because of the fact that we continue to see strong rent growth and strong vacancy compression, values have continued to appreciate, and we're well above our Great Recession era peak or pre-recession peak. Again, we did expect to see possibly some flat or negative value after the pandemic hit, but again, we've surprised to the upside. All that fiscal stimulus and the strong recovery in leasing has helped this market a lot. So I hope.
Great job, really. That was extraordinary, and I know our viewers will benefit greatly by that, which is probably the most comprehensive coverage of the commercial real estate market that you'll find anywhere. And David Kahn is the market director of CoStar Analytics here in Atlanta. And if you are interested in becoming a member of and getting a membership in CoStar, I know that you can get a hold of David or call me. I can help you. There's his email address. But they do have the most comprehensive analysis available. Normally, you have to pay quite a bit of money to have that information. It's not readily available to non-members, so we're more than happy to present that information to to our viewers. And David, great job. Thank you so much. And would love to have you come back on a regular basis and keep our viewers posted on the market. It's sort of like a free ticket to the best real estate show in town by a mile. So thank you very much, David. And also, this is going to be on my website, atlantacommunityprofiles.com. I also emailed this out to all the realtors. And if you are not getting my MailChimp emails of my shows, please send me an email, lou@louwieland.com, and we'll be sure and add your name, to that list. So thank you, David, and thank you, Donna Davis, President of Pro Video Talent, for producing this program. Thank you very much for watching, and please let me know if I can help you in any way with commercial or residential real estate or investment property. Thank you for listening, and thank you, David. As always, we appreciate your outstanding help. Have a
Thank you,
nice
Lou,
day.
and thank you, everyone.
Thanks for listening and watching.